Hello and welcome back to Global Value. In today's video, we are going to be performing a fundamental stock analysis of the Coca-Cola Company, ticker symbol KO. Coca-Cola has been a long-time holding of Berkshire Hathaway, with Warren Buffett having invested in the business back in the late 1980s and adding to the position during the early 1990s. Since then, Coca-Cola has been a familiar name in the Berkshire Hathaway public stock portfolio, with Berkshire owning about 9% of the business. Currently, as of their last 13F, Coca-Cola is Berkshire Hathaway's fifth largest public stock position. Warren Buffett has called Coca-Cola his prototype of a wonderful business, and at the time of recording this video, Coca-Cola is trading for $63.38 per share. Year to date, their stock price is up 7%, which is in stark contrast to the overall market. Over the past year, their stock price is up 13%. Going back 5 years, their stock price is up 7% compounded annually. Over 10 years, they're up 5% compounded annually. And going back prior to the global financial crisis, the Coca-Cola Company has compounded at a rate of about 6.5% each year. Keep in mind that their stock price return is not including the dividends that they paid out. Coca-Cola is a Dividend King, meaning that they have increased their dividend each year for the past 50 years. In Coca-Cola's case, they've actually increased their dividend for each year of the past 60 years. And Coca-Cola currently pays out a 2.8% dividend yield, which is higher than the overall market. So Coca-Cola is trading $4 under their 52-week high, which is up about $12 from their 52-week low. Coca-Cola is a very large business. They have a $274 billion market cap. For some more background about the business, Coca-Cola is the largest non-alcoholic beverage entity in the world, owning and marketing some of the leading carbonated beverage brands such as Coke, Fanta, and Sprite, as well as non-sparkling brands such as Minute Maid, Georgia Coffee, Costa, and Glacier. Operationally, the firm focuses its manufacturing efforts early in the supply chain, making the concentrate or beverage base for its drinks that are then processed and distributed by its network of more than 100 bottlers. Concentrate operations represent roughly 85% of the company's unit case volume. The firm generates most of its revenue internationally, with countries like Mexico, Brazil, and Japan being key markets outside of the United States. The Coca-Cola Company was founded in 1886 and is headquartered in Atlanta, Georgia. So for today's fundamental analysis, we're going to be performing a modified version of the 8-pillar analysis popularized by Everything Money, taking a look at 8 key financial metrics of the Coca-Cola Company and coming to an overall holistic and beginning understanding of Coca-Cola based on those fundamentals. So let's get right into it. Starting off with pillar number 1, we want their average 5-year PE to be below 22.5. Currently, Coca-Cola trades at 29 times earnings. Over this time frame, they traded all the way at a high of 167 times earnings, which is probably due to some sort of write-off or something else flowing through their earnings. And they've traded at a low of just 18 times earnings. Overall, it looks like they had extra expenses flowing into their earnings or something impacting their earnings from about the middle of 2018 to the beginning of 2019. If we exclude that time frame, Coca-Cola is trading at about an average of 28 times earnings. If we include that time frame, they're trading at an average of 46 times earnings. Either way, it's higher than that metric we're looking for, and this is going to be an X to start off here on pillar number 1. Pillar number 2, we're looking for an average 5-year return on capital that's above 9%. So over the long run, over the course of decades, a stock is going to return approximately what its underlying business returns, and these business returns are going to be captured here by return on capital. So the Coca-Cola Company produces very steady returns on capital. Over this time frame, they've all been in the mid-teens, and overall they're averaging almost exactly a 15% return on capital. So that's above the 9% we're looking for, and this is going to be our first check here on pillar number 2. Pillar number 3, we're looking for 5-year revenue growth. Coca-Cola has grown revenues very slightly over this time frame, from $36 billion in 2017 up to about $38.5 billion in 2021. So this is 5-year revenue growth, and this is going to be a check here. Pillar number 4, we're looking for 5-year net income growth. In 2017, they both had a write-down and a loss on the sale of an asset. So they only had $1.2 billion in net income in that year. And last year, they had about $9.7 billion of net income. So this is going to be a check here on pillar number 4. So far through 4 pillars, we have 3 checks. Pillar number 5, we're looking for decreasing shares outstanding. When you purchase a share of stock, what you're really doing is buying a fractional ownership percentage in that underlying business and decreases the amount of stock that they have outstanding. They're increasing your ownership percentage in the business without you having to spend a dime. So we want businesses that are buying back stock when their prices are trading for reasonable valuations. Coca-Cola has more than 4.3 billion shares outstanding, and here they've only diluted shareholders by about 16 million shares. So this means that they pretty much kept their shares outstanding flat over this time frame. That's less than a 1% shareholder dilution. However, this is going to be a slight dilution nevertheless. This is honestly not something to worry about, and it's much better here that we don't see a drastic shareholder dilution, especially as a business with as potentially strong moat as the Coca-Cola Company has. In the mid-1990s, someone asked Warren Buffett which company he thought had the strongest moat, and he replied the Gillette Company for Gillette shaving and razor. In 2008, shortly after the global financial crisis, they asked that same question to Charlie Munger in an interview, and in his opinion, it's the Coca-Cola Company that had the strongest moat at that time. While that might not necessarily be the case today, it's a strong consideration that Coca-Cola has a wide moat. Next up, for pillar number 6, we're looking for 5-year free cash flow growth. Free cash flow is cash from operations minus capital expenditures. It's this column here in green. Free cash flow is the lifeblood of any business, and a business's abilities to produce free cash flows now and until Judgment Day, discounted back by some reasonable interest rate, is ultimately what that business is going to be worth. Free cash flow can be used to make acquisitions, reinvest back into the business, pay down debt, buy back shares, and pay dividends. In 2017, Coca-Cola produced $5.3 billion of free cash flow, and that increased to over $11 billion in 2021. So this is a check here. Over this time frame, they've more than doubled their free cash flows, and in an average year, Coca-Cola is producing about $8 billion of free cash flow. So we'll be using that number coming up here on pillars 7 and 8. One thing we can also take away from their free cash flow profile is that Coca-Cola, relative to their free cash flows and their cash from operations, is not having to spend a huge amount on capital expenditures. So Coca-Cola is a relatively asset-light business that's still earning above average returns on capital and still has a long global runway to continue expanding their operations and continue distributing and manufacturing even more bottled beverages. Next up, for pillar number 7, we want Coca-Cola's net debt, which is long and short-term liabilities minus cash and short-term cash equivalents, to be below their average 5-year free cash flow multiplied by 5. So as of the end of last year, Coca-Cola had nearly $31.5 billion of net debt. When we multiply their average 5-year free cash flow of $8 billion times 5, that brings us to $40 billion, which is more than their net debt. This is going to be a check here on pillar number 7. If Coca-Cola keeps producing average years of free cash flow into the future, they'll have more than enough money to pay off all of this debt. This is a sign of a strong business. This is a sign of a conservatively financed business that is not overly levered. We don't want to be investing in overly levered businesses because in times of economic hardship, those businesses are either going to have to raise capital or refinance their debts, and they're likely to do so at unfavorable terms. Plus, the more leverage a business incurs, the higher potential it has to go bankrupt. So in Coca-Cola's case, they produce more than enough free cash flows to cover all this debt. So while it's not a guarantee, it looks like that would be a pretty unlikely situation here. Finally, the big pillar of them all, pillar number 8, we want their market cap to be below their average 5-year free cash flow multiplied by 20 to give us a reasonable starting point as to a valuation for the business. So currently, Coca-Cola has a $274 billion market cap. When we multiply their average 5-year free cash flow of $8 billion times 20, that only brings us to $160 billion. That's an X here, and we're off by nearly $114 billion. Now, for a business as strong as Coca-Cola, it's probably worth paying a premium for the business. However, it's going to take more research to decide what that premium should exist at, because no matter how strong a business is, you can't pay an infinite amount for that business and expect to have outsized financial returns. While it's probably worth paying up for Coca-Cola in some cases, this still looks like quite a large gap if you think that that's a reasonable number to start with. So again, that's an X here on pillar number 8. Then Coca-Cola is a dividend king. They have 60 years of increasing dividends. So here we're looking at their dividend profile. Investors make mistakes all the time by blindly chasing dividend yield. Instead, we want to stop and consider whether a dividend is healthy and supported by a business's abilities to produce cash flows. Here, in the past 3 years, Coca-Cola has produced more than enough cash flow per share to pay off their dividend. However, in 2017 and 2018, that was not the case. And even in the years where they produced more cash flow than what they paid out in dividends, it hasn't been by a lot. Last year looked like one of their healthier years over this time frame. And we can see here that Coca-Cola's dividend increases per share have been pretty incremental at best. They have not been increasing by that much of a percentage over this time frame. And so based on their abilities to produce free cash flows, it looks like they would keep incrementally increasing their dividends per share. But again, it would probably just be step-by-step incremental and slow growth now and into the future. So again, this is a historical snapshot and it's not any guarantee, but it looks like their future dividend increases are going to be smaller at best. Lastly, here we're looking at a discounted cash flow model for Coca-Cola. Historically, since 1990, Coca-Cola has been able to grow their free cash flows at a rate of about 7.6% per year. So if we assume that they can continue that growth rate for the next 10 years, and then at a terminal stage of growth over the next 20 years after that at about 4%, assuming that that rate would fall in half, then based on the amount of free cash flows that Coca-Cola is currently producing with that growth rate and then factoring their tangible book value, it looks like at this stock price, Coca-Cola would be producing about a 6% rate of return. So based on these assumptions and based on their historical growth numbers, if you would purchase Coca-Cola today, you could reasonably expect that if you held the business for 30 years, you would earn about 6% on your money. So not an outsized return, but Coca-Cola may be a stable and steady business now and for a long time into the future. And so depending on your personal circumstances, you want to both understand if you think that these numbers are accurate and complete and understand how this would work for your individual situation. Again, this type of analysis and this type of discounted cash flow model are not financial advice. Before making any sort of investment decision, you should check in with the right professionals and do your own due diligence into any business. So in summary, the Coca-Cola Company checks the box on 5 out of 8 pillars. They're currently off on our valuation metrics and they pretty much kept their shares outstanding flat but have had a tiny bit of dilution. Coca-Cola earns above average returns that are pretty steady in the mid-teens. And over this time frame, they've grown revenues, net incomes, and free cash flows. The business is also reasonably financed and not overly levered, although it does look like their abilities to support their dividend now and into the future are only going to include incremental dividend growth at best. And finally, based on the historical assumptions of that discounted cash flow model, based on Coca-Cola's historical numbers, if you purchase Coca-Cola today, you could reasonably expect about a 6% return, including dividends there. You don't want to make the mistake of counting dividends twice there. They would be included as part of that 6% return with that discounted cash flow model. This type of analysis is a holistic and beginning starting point to determine whether it's worth your while to do further due diligence on Coca-Cola. It is not financial advice and it's not a buy or sell recommendation of the Coca-Cola Company. Consult with the right financial professionals and legal professionals before making any sort of investment. Do your own due diligence to learn the ins and outs of a business as if you owned 100% of it before coming to any sort of conclusion. So with that said, that's it for today's fundamental stock analysis of the Coca-Cola Company. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what kind of business you want me to take a look at next time. Thanks for learning about Coca-Cola with me, and have a great day.